Welcome to the deep dive. We're your fast track to getting genuinely well informed. Today we're digging into the latest from American Express, specifically their Q2 2025 results. We're looking beyond just the numbers, trying to see, if that premium strategy is holding up against rising costs, or are there any maybe hidden issues? Our source here is a pretty dense financial report. We've boiled it down for you, pulling out the key nuggets. So our mission really is to help you quickly understand the main figures, what's behind them, and what they might signal about Amex's path forward. Okay, let's unpack this, right? Kicking things off with the big picture numbers. American Express reported earnings per share, that's EPS, basically profit per share of $4.08.
Yeah, and that $4.08 actually beat the Zacks consensus estimate by 5.7%.
Which is pretty solid. And it's up 17% from last year, too.
Exactly. And revenues, total revenues, net of interest expense, came in at $17.9 billion.
Also beating the Zacks estimate, right, by 1%.
That's right, by 1%.
Yep.
And up 9% year over year. So like you said, strong top-line results.
Definitely looks good on the surface.
It does. And what's immediately striking isn't just that they beat, but kind of how. The report points to growing card member spending.
Especially the premium ones, I imagine.
Precisely. They're premium-based spending more. Plus, you've got rising revolving loan balances that's interest-bearing debt carried month to month and really robust card fee growth.
Okay, so multiple drivers there.
But there's always a but, right? The flip side is these positives were, well, partly offset by higher costs, customer engagement costs, operating costs. They're climbing.
That classic balancing act. Growth is great, but it costs money to get it and keep it.
It really is. You have to consider both sides.
So given how much Amex leans on that premium segment, are these higher costs just, the cost of doing business, a necessary investment, or could they actually drag down margins later?
Well, it's likely a bit of both, isn't it?
Yeah.
They pour money into benefits, services, things that premium cardholders expect. That builds loyalty, drives spending.
Exactly.
But it absolutely means a higher cost base. So the big question becomes, can the spending and fee growth keep outpacing these engagement costs? That's the key.
Yeah, that really is the million-dollar question. Okay, let's shift to the operational details. Network volumes. That's the total spending on their cards, right?
Exactly. Total transaction value.
Reached $472 billion. That's up 7% year over year. Driven a lot by U.S. consumers spending more, it looks like.
And it also beat the Zacks estimate by about 1.3%.
Okay. And interest income.
Total interest income hit $6.3 billion, up 8% year over year, also ahead of consensus.
So money coming in looks strong.
What's fascinating here is how that plays against the provisions for credit losses.
The money they set aside for potential defaults.
Right. While income was up, those provisions also rose by 11% year over year to $1.4 billion.
Why the jump?
The report says it's due to higher net write-offs, basically, more people actually defaulting, and also a net reserve build. So they're proactively putting more aside just in case.
So kind of a prudent move alongside the growth. It seems that way. As borrowing grows, they're buffering against potential issues down the road.
Got it. Now, on the other side of the ledger, expenses. Total expenses jumped.
Wow,
14% year over year to $12.9 billion.
Yeah, a significant increase.
And the report links that directly to higher operating costs and those customer engagement costs we mentioned.
All that spending on travel benefits, perks.
Yeah.
It adds up when card members actually use them more.
Definitely seems to have a price tag.
Okay.
Okay, so we see the overall revenue and cost picture, but let's zoom in. Where are the wins and maybe the challenges within the different parts of Amex?
Good idea. Let's break down the segments.
Starting with U.S. consumer services, pre-tax income was $1.7 billion. That's up 7% year over year.
Still pretty good growth.
Yeah, though it did slightly miss the Zacks estimate by about 4.7%. But revenues for this segment were strong, $8.6 billion, up 11%.
And what's interesting there is the note about growth among younger customers, Gen Z, millennials.
Right. Shows Amex isn't just for, the older, established crowd anymore. They're pulling in younger folks, which is important for future growth, definitely.
Okay, what about commercial services? They're business clients.
Pre-tax income, there was $905 million.
Okay.
Basically flat compared to last year, and it also missed the Zacks estimate.
But revenues?
Revenues were $4.2 billion, up 7%, and that actually beat consensus, mostly driven by higher net interest income, it seems.
Okay, so a bit of a mixed bag in commercial.
Now, here's where it gets really interesting. International card services.
Oh, yeah. What happened there?
Pre-tax income just exploded, jumped 60% year over year, 60 to $465 million.
Wow, 60%. That's huge.
Absolutely blew past consensus estimates. And revenues were up a solid 15% to $3.2 billion, also beating expectations.
So international is clearly firing on all cylinders.
It really looks like a powerhouse right now. Suggests their international expansion strategy is paying off significantly. That's crucial for diversifying away from just the U.S. market.
Definitely a bright spot. Okay, then there's global merchant and network services. That's the network and merchant side.
Right, managing the payment network, relationships with businesses that accept Amex.
Their pre-tax net income actually fell, down 31% year over year to $1.1 billion.
Which sounds bad, but
But interestingly, it still beat the Zacks consensus estimate, and revenues were up slightly, 3% to $1.9 billion.
yeah, so the income drop needs context.
And briefly, corporate and other had a wider pre-tax loss of $550 million.
Okay, so if we connect this to the bigger picture,
Mm-hmm.
what do these different segment stories tell us?
Well, it looks like the U.S. consumer business is solid, still core.
Right, reliable growth. But that massive jump in international card services,
Yeah.
that points to where the real momentum is, a successful global push.
And the dip in merchant income, even beating estimates.
It suggests perhaps they're navigating some changes, maybe network fees or higher costs for signing up merchants, possibly investing more in that area, which could hit short-term profit.
So it's this dynamic mix nurturing the core, but really pushing hard internationally, maybe while tweaking the merchant side.
Exactly. Shows where their strategic bets are.
Okay, let's shift gears slightly. Balance sheet and capital. As of June 30th, cash and cash equivalents were $57.9 billion.
Yep, that's a big jump from the $40.6 billion they had at the end of 2024.
And total assets grew, too, to $295.6 billion from $271.5 billion.
On the other side, long-term debt also went up. $58.2 billion now compared to $49.7 billion at year-end 2024. Short-term borrowing was $1.5 billion.
And shareholder equity, the company's net worth.
That improved, up to $32.3 billion from $30.3 billion. But here's an interesting metric for investors. Return on average common equity, or ROE.
How efficiently they generate profit from shareholder money.
Right. It was 37.8%, which sounds high, but it's actually down from 43.2% a year ago.
So profits are up, equity is up, but the return rate dips slightly.
Yeah, it suggests maybe the cost of generating that growth has increased or the efficiency has shifted a bit. Something to watch.
Makes sense. And how are they returning capital to shareholders?
Well, they bought back stock. 5 million shares for $1.4 billion in Q2.
Which helps boost EPS by reducing the share count.
Correct. And they paid dividends, too. $600 million total, which worked out to 82 cents per share for the quarter.
So definitely returning cash via both buybacks and dividends.
Clear commitment there.
All right, finally, let's look ahead. The outlook for the rest of 2025.
They reaffirmed their guidance, didn't change it.
They expect revenues for the full year to be up between 8% and 10% compared to 2024.
And EPS is expected in the range of $15 to $15.50.
The middle of that range, $15.25, would be about an 8.9% improvement from 2024's actual results.
And importantly, they also reiterated their longer-term goals, revenue growth over 10% annually, and mid-teens EPS growth. So they're projecting confidence beyond just this year.
So what does this all mean for Amex's future path?
The outlook basically says we expect the strong performance to continue. It signals they believe in their strategy investing in growth, especially internationally, doubling down on premium customers, even with those rising costs we talked about.
Okay, so wrapping this up, our deep dive into Amex's Q2 shows a company executing pretty clearly, strong top-line growth.
Fueled by that consumer spending and fee income.
Right. And that international segment performance was really a standout. Shows where momentum could be building.
Definitely. And it's clear they're continuing to spend heavily on customer engagement.
Which, as we noted, hits the cost line. It's that trade-off again.
And this really raises an important question for you, the listener, to think about.
Yeah.
How will American Express keep balancing this? The push for more spending, particularly from premium cardholders, against the rising costs of keeping them engaged with perks and travel benefits. Can they find new efficiencies? Or is their profitability just dependent on scaling faster than costs rise? Is there a limit?
That's a good question.
It's definitely something to mull over as you keep thinking about the financial landscape and Amex's place in it.